Welcome, everyone. It's Angelo Robles to the Angelo Robles Podcast. I'm also the founder and CEO at Family Office Association. Today, we're going to cover the best asset protection strategies for cryptocurrencies, featuring Dan Morris, founding partner of Morris and D'Angelo. We're actually going to cover more than just the asset protection side, taxation, even wealth transfer, and we'll go a little bit beyond cryptocurrencies as well, because some of the principles for other assets would not necessarily, especially property, be any different than for cryptocurrencies, but there are some nuances. So as much as I covered Bitcoin, Ether, DeFi, and the digital asset ecosystem, I don't think in the last 5 or 6 months since I've been more active in this that I've really done anything on the taxation side, the asset protection side, and the wealth transfer side. And I can't think of a better person to have than Dan Morris. Dan, welcome to the show.
Thanks, Angelo. It's a pleasure. Thank you.
Well, I mean, I've enjoyed your presentations and speeches about how families of wealth, they often may have a good investment plan, perhaps acceptable tax strategies, but so many of them don't really give the attention to asset protection. What could go wrong? So before we maybe dive more specifically into cryptocurrencies and go off on, well, with me, a million different tangents, why don't we lay the foundation for the importance of asset protection? To some people, it almost, especially about 10 years ago, kind of became a dirty word, almost as if you were hiding something, a fraudulent conveyance. If you could let the audience know more simply and broadly and hopefully more friendly that it doesn't have to take such an onerous tone.
Yeah, look, anybody of wealth, and I don't care whether you're starting out in wealth or you're a family with, hundreds of millions, if not billions of dollars, we want to all protect that which we have, right? So asset protection strategies are about stopping the unintended dilution or losing of our funds and funding. So from my perspective, look, we're a litigious society. If you have money, other people want it. So this is nothing to do about tax avoidance at the moment. This isn't anything to do with anything about that. It's about protecting the familial wealth and preservation from unwarranted lawsuits, enhancing your financial privacy. In other words, people will come to me and they'll say, Dan, I need to start a new business, but the last thing I want is for somebody to go to the local state register of companies and have my name plastered on it. How do I avoid having my name immediately plastered there so that I can avoid litigation or conflicts of interest or other people just snooping around, right? We have lots of people watching. So financial privacy, wealth protection. I want to be able to deal with legacy planning. I want to make sure that my next generation has a foundation from which to springboard for the future. We've got statute of limitations issues, right? Bad things can happen, but if I can find a way to minimize my risk, I've got court protections. In other words, I need jurisdictions that courts respect. Family planning, and I don't mean birth control. I mean family planning as, what do I want to deal with my legacy? How do I generate, how do I help coach and guide my grandchildren and my great grandchildren when I'm probably no longer here? And of course, finally, there can be tax planning opportunities with asset protection, because taxes are probably the largest single expense that a family occurs.
Oh, no doubt about it. It's one of the things they actually have potential, and I know there's various degrees of pushing the envelope, but they actually have direct control over, including some of the other things that we're talking about, where they have no crystal ball exactly what's going to happen on their investments. So I've always said the importance of mitigating taxes, of wealth transfer, and of asset protection, especially for the uber wealthy and family offices, really being of the most paramount of importance. Since we are going to dive somewhat specifically more into crypto, and I know this may sound basic, but again, I don't want to make that assumption for the audience. I think they know that it's not considered a currency by the US government, it's considered property. If you could explain to the audience what that means from a tax perspective, and if that has any difference, I'm assuming not, on asset protection.
Yeah, I want to clarify that a little bit. It depends on which department you're talking to. if you're talking to FinCEN, right, they might want to call it a currency so they can put monetary supplies on it. But the Internal Revenue Service has deemed it to be treated like property. So it's income when you receive it in the form of payment for services, or it's your cost basis if you pay for it. And when you sell it, you are subject to short-term and long-term capital gains based on the difference, or losses, clearly, based on the difference of what your purchase price or your acquisition price is and your ultimate sales price. You no longer can do exchanges, right? I mean, you can do an exchange, but you can't get a tax-free exchange. The Commodities Board would like to treat it like a commodities. The Securities Exchange Commission would like to treat it like a security. And so we essentially have four different definitions depending on which version of our government we're talking to. But from an internal revenue standpoint, an IRS perspective, it's property, and that's a real key. Even though it's an intangible property, right? It's treated in that manner. So, in essence, acquisition. If I'm paid in crypto, it's profit to me that day, right? And then I have to track it, and I have to track it conceptually on a transaction by transaction basis. And if I don't, then it's probably going to be on a first in, first out basis, and that would be tax inefficient. So it does require a level of sophistication and tracing so you can figure out what your cost basis is to avoid paying a tax when you higher than you should.
And obviously it's on the top of page one on a 1040. It's definitely in the crosshairs. And the government, well, what a surprise. More people getting crypto going up. Boy, they can make money on taxes. So of course it's taxed as a property and it's right in your face on page one. I inevitably think, similar to real estate, it'll be taxed from a property perspective annually, depending on the valuation of your crypto. And very simply, it comes down to money. It's a way for the government to make money. I could argue it's a way for them, and I'm not going to use the word allow it to be legal. That's going to get a very complicated subject that we could discuss. But there's things the government could do where they're not technically making it illegal, because that may be not applicable to certain constitutional rights we have here in the US, and the fact that it's decentralized as well. There's not one person or one computer, but they can make it difficult. But if they also see that people are buying it or motivated by it, or it's going up in value, well, they could make money. So that's the option, of course, the government's always going to take. Talk a little bit about the taxation currently in terms of, I guess, if it's long-term capital gains. What is the long-term capital gains rate? And then I guess that's a good segue to the Biden tax proposal and how that may go up drastically.
Yeah, well, currently, and I'm going to assume that our audience is in the maximum tax rate, because I'm going to assume that they're making more than $450,000 annually. The top tax rate on a 1 year or more sale of a qualified cryptocurrency is 20% plus what we refer to as the Obama Medicare tax, so 23.8 at the end of the day. And if you live in a high tax jurisdiction, New York, California, other places that are losing population, you can get in a hurry another 14%. So you can be at 37% tax on the profits. And you mentioned it being on the front page of the tax return, and candidly, what had happened is clearly people forgot about their crypto, right? And oops, right? Oops, oh gee golly whompers, right? And so under that penalty of perjury, if you say no to that crypto question and it turns out you have crypto, well, that would be under penalty of perjury, and that could be subject to a civil and or criminal matter, right? And if your crypto is offshore, a dramatic, I've always been a fan that when in doubt, report, because it doesn't cost you anything. But there's a very interesting form that I refer to as a new form, which means it's been out since 2011, by the way. A new form, to be an old form, you better be 30 or 40 years old, because it has to get vetted. This is called the Foreign Financial Asset Form. It's an 8938. It's technically a felony if you don't file it and it's supposed to be. Now, I don't know if anybody will ever be accused, and your tax return is not complete if it's supposed to be filed and it isn't filed, so the statute of limitations doesn't run. So that if you have a wallet that's outside the United States, or you have crypto that's outside the United States, or any foreign asset, I don't care if it's real estate, follow the rules on that form, and when in doubt, disclose and avoid that. It is horrific for people to be ignorant and candidly say, well, how would they know? That's idiotic. It's just completely idiotic. It violates everything about what the value of the distributed ledger technology really is, which is nothing more than a big general ledger of where everything is. So it's in the public.
Right. And I think people may underestimate the power of the government, their unlimited resources, the level of technological resources they have, how they could basically hire the best and the brightest right out of MIT and just pay them more, in theory, than anyone could pay them. And what they could do on chain analysis and stuff like that, you're kind of, and now with the KYC, and I know that's relatively newer with the exchanges, you're fooling yourself. Now, you could make the argument, maybe those that go back to the early days of Bitcoin and strict, maximalist and don't use it. It strictly as a store of value. I suppose that might be off the grid. But if you don't answer that question as a US citizen, the potential repercussions, as Dan noted, could be very, very severe. I know a lot of maximalists probably don't want to report it, want to keep it off the grid, don't want to pay taxes. Whether I may agree with you from a libertarian perspective on much of that, the reality is you live here in this country, you're a citizen, you have to obey its guidelines. And that is what it is, whether we like it or not. If you don't like it, then I guess the option is to get rid of your citizenship and go somewhere else. Oh, and by the way, a lot of other countries are worse than we are relative to some of these issues surrounding crypto. And we may dive a little bit into that from a tax and an asset planning perspective as we progress during our conversation. Now, there are some strategies historically used in more wealth transfer and charitable planning that could very well be applicable to crypto. If you could talk a little bit about charitable remainder trust and charitable lead trust and how they may be valuable strategies.
Sure. In all of the charitable trust kind of structures, and whether they're remainder trust or lead trust or they're private foundations, if you have appreciated property and you contribute that appreciated property that can be validated to its value, you can receive a current tax benefit. I mean, let's be candid. When the Gates Foundation was formed, the Bill and Melinda Gates took appreciated Microsoft stock. They contributed to the foundation. I'm sure they have a tax benefit for it. I don't do any work for them, so I don't have that data, but they were able to take a great advantage without having to pay the tax. So, to the extent that you're looking for current cash flow, as in a remaindering trust, right? Mm-hmm. I want to have some cash flow in. I could, and I have a charitable intent. My position on whether you take real estate or art or Bitcoin, if you want to go into the charitable world, to have a charitable heart and a charitable intent, to the extent that there are tax advantages, you should take advantage of those. But let's start with the realities. It doesn't help anybody to create fancy trusts that avoid taxes or minimize my current taxes if it isn't aligned with the spiritual values of the family. I mean, it just doesn't help us, because we get to a spot and we go, why did we do that, right? So contributing highly appreciated property, if you've got the spiritual intent for charity, smart move, and you should do it.
And if you could give the briefest definition within 60 seconds of a charitable remainder trust and the difference between a charitable lead trust.
You should have given me a little bit of, the charitable remainder trust as a general rule is I provide the asset, I get paid monthly or annual installments, and at the end of the term, the charity receives the remaindering, right? I mean, that's why it's a remaindering. And on the lead trust, I always have to go back and look at that. And I'm sorry that's it's the charity generally gets the item up front, but be candid, that's probably not that's why I have business partners, right? So
Yeah, I
You
mean,
know,
pretty much it's kind of the reverse of the charitable.
it's the inverse. It's does the charity get the benefit now, or does the charity get the kind of the benefit later? And is it a known contribution or an unknown? And so it's all designed to provide the avenues for families to have asset access now or have access later.
And how about a family foundation, a private foundation?
A private foundation provides. There's two types. There's one that only provides subsequent. A private foundation is literally a corporate environment, like the Ford Foundation or the Packard Foundation or the Gates Foundation. You create a non-qualified nonprofit. You contribute property. You can receive property from the public at large or just your family. You have obligations to utilize a minimum of 5% of each year's beginning value into your charitable intent. They can be in a whole host of things. They can be in medicine, they can be in art, they can be in spirituality and religion, they can be in lots of things that have a qualifying purposes for making the world a better place. In my view, what happens is people would prefer to pay their family a tax instead of paying the government a tax. And you can hire family members. You can do a whole number of things to move the world better in utilizing a private foundation. They're public documents when you file them. So whatever it is that you do in the family, understand you have to be wary of self-dealing, but they are a good mechanism for people of large means.
And let's talk about two, I guess I would call them advanced strategies that I discussed in my masterclass on creating and adapting to a anti-fragile family office. And that would be the opportunity of owning a bank, specifically an offshore bank. And I looked it up a couple of months ago. There was like 27 of them available in Switzerland. Now, there's lots of regulatory issues. It can't be solely for you. Those days, especially in Switzerland, long gone. It needs to be a commercial enterprise. And I'm wondering why there were so many banks for sale. And the reality is it's gotten hyper competitive. A lot of these are very antiquated. Their technology is woefully outdated. And their pricing and their whole model is being gravely challenged in today's world. That being said, there are some advantages. We don't need to do a 1 hour about it in terms of being an owner of a bank, but especially in a jurisdiction like a Switzerland, even for a US citizen, the opportunity to buy, to recapitalize, and have that money that's needed within the bank. If something were to go wrong from an asset protection perspective, that is pretty darn secure in terms of trying to go to Switzerland and get that money that's needed for that bank to exist and pull it out because a lawsuit against you. If you could talk a little bit about the dynamic, and I know this is very, very niche, but the power of being involved in a bank, especially in the right jurisdiction.
There's a lot of pressure to find to acquire a bank. They're difficult. One of the reasons there are so many for sale is that they're difficult to get a banking license today, especially with Brexit and the EU moving as it is. They're full of anti-money laundering and associated controls. There's an entire new world of what we call e-platform banks, which are effectively IBAN grantors, right? And so having access to a bank provides an avenue not only for a family or a group of families to provide funding liquidity, but they come with, in my view, they come with a long tail of obligations, right? Because you're owning a bank, you're having an ability to touch directly or indirectly the SWIFT system. You have the ability to deal with banking. So it's not a panacea, but owning a bank does provide a platform for a family to protect its privacy in a private banking standpoint, the ability to have current accounts and access brokerage accounts and access additional financial products through the veil of something that they control. I hope that makes sense, but it can be a good strategy, but they're not as easy to necessarily acquire just because they're for sale.
Tremendous regulatory hurdles. It's very frustrating. There are some advantages. What I would add is those advantages are lesser now, and especially moving forward in the future than ever before. To some degree, Bitcoin and crypto replaces some of that value for a family in terms of owning a bank, especially if they keep their own keys and have some level of jurisdictional fluidity. It's their money and could go wherever they want, and some of the level of protection and privacy, if they're very astute and very careful on their cyber and other protocols, the value. But the bigger point I was going to get to is I think small banks and mid-sized banks are in a heap of trouble relative to what's happening in DeFi. Decentralized finance is going to completely upend centralized finance. That being said, for certain families, where making additional income means practically nothing to them. It simply is a privacy and asset protection play. So we're probably talking families at multi-billions. It's still in the right jurisdiction could be an interesting strategy. And again, arguably for the lay wealthy person, properly structuring your crypto could give you some of those benefits. Why don't I put it that way? The other one that I wanted to mention would be effectively a insurer. More than likely, let's focus on an offshore captive insurer. If you could talk about the benefits of that and how crypto may play into that.
Sure. I mean, look, whether it's onshore or offshore in the effective capital in the captive marketplaces, right? I've got I think families should leverage captive insurance, which for the audience is essentially you're creating your own private insurance company, and it has to be a real risk-taking adventure, right? And you will generally partner with a Marsh or somebody like that to help you design these appropriately. And you're going to have reinsurance, but you can do a couple of things. You can actually insure for liabilities and risks that maybe a public insurance company doesn't have a real appetite for. There are tax advantages to it, meaning you can take, if you're paying real premiums, you get current deductions. And I'm not worried about whether or not you're qualifying for a future tax benefit in the United States, but you're taking real risks. You have to pay real claims. Now, one of the things you can do is there's no reason that you couldn't create an insurance product. If you were sitting on, I don't care, $1 billion worth of Bitcoin or effective crypto, what's your biggest fear? It's worth $500 million tomorrow and $250 million 3 days later because somebody somewhere does something. And it may be a temporary value deduction, but that's a real risk. What if you could insure that risk by paying a premium, right? And offloading some of that risk. Now you might spend $100 million of your crypto to guarantee that risk. Well, but hold it. But if you own the underlying company, right? So if it's kind of like participating in an options market, right? If I've written some calls or some puts, how do I do that? That also leads to a whole nother conversation that all of the synthetics that are out there as it relates to crypto and funds and what can you do to not create a tax event, but to shore up that risk. The other thing is you can do insurance is still a tax advantaged vehicle, even under the Biden plan. So if I bought high value private life insurance, right? So using a PPLI, kind of a private placement life insurance program, could I utilize my crypto to do that? Could I create a huge premium that could provide a step up in basis and or tax-free conversion to my family? Things to look about. So if I've got a portfolio of assets, it's a global, holistic aspect in nature and cannot be done in isolation. But captives is another arrow in our quiver of opportunities to figure out how to reduce the downside risk from a sudden shock that we don't know, that we can't anticipate. And I'm not talking a black swan event, but crypto can go down 20% in a day just because, and it can go up 20% in a day just because, right? And that's the volatility challenge of any coin. Now it's harder to do with crypto and $50,000, $60,000 for Bitcoin, but it's very easy to do in the altcoin market.
Yeah, no, that's very interesting insight that I'm sure a lot of our audience has never been too familiar with. And I do hear some families of wealth say captive insurers sound great on the surface, but relatively a modest amount. It's still millions, but that you get the tax advantage for what you put in annually. And unlike a lot of the benefits of the captive from a variety of other perspectives, it's not singularly limited just to saving money on taxes. It's much deeper. So now that we're bringing in crypto into it and some of the opportunities that you laid out, again, I've been a big believer in banks. I've softened my stance a little bit on that, but for the uber wealthy, look at that and look at insurance companies. It's kind of worked pretty good for Warren Buffett in
Yes, it
Berkshire. I
has.
won't bore everyone with the details of the difference between a reinsurer and onshore and offshore. We've covered that with Ed Wrenn at Withers Bergman a couple of months ago, and probably due to update that into a deep 90-minute to 2-hour dive. But these are all broadly strategies you should have some familiarity with so you could do your own thesis and make your own decision. You did bring up something that is one of my favorite strategies that after all these years, I feel is still so underutilized, no matter how passionately I talk about it. And like I said, with crypto being, let's call it the poor man's bank, and it's more complicated than that, PPLI is something that could, I'm not going to say replace a captive, it's different, but for certain families looking for certain things, it's a way easier a structure than a captive. And depending on their goal, might even be more powerful. If you could talk a little bit broadly about PPLI and how crypto could play into that.
Right. I mean, the concept of PPLI, private placement life insurance, is that you effectively self-fund your own underlying. You take the place of New York Life effectively through funding it in your own assets. Sometimes you have to use those reinsurers depending on the early phases, but you're able to contribute those familial assets that may be illiquid today or have a low basis, and in exchange for the life insurance contract. And the insurance company can then run them, manage them, sell them, be able to deal with the investment portfolio aspect of them in a tax advantage methodology. And then, of course, clearly it's life insurance. So upon the insured's passing, the life insurance contract, generally in an what we call an ILIT, an irrevocable life insurance trust, right, would go on to it'd be liquidated into the next generation without a layer of estate tax. And remember, people focus on the income tax, but our wealth transfer tax in the United States is dramatic. It's north of 40%. It starts today just north of 11.5, $12 million. It's on the chopping block, whether or not you do or do not get a step up in basis in the future, right? So there's a lot of aspects as to how to avoid, in my view, how to avoid losing my wealth through inheritance.
Yeah, I mean, I could go on forever about PPLI. I mean, you're leveraging the premium for a very tax-favored death benefit for wealth transfer and for your heirs or for a charity, whatever it may be. The tax advantages are so extreme. It grows tax deferred inside the wrapper of the policy, but it gets even
Right.
better with first in, first out, and very few things offer that. You could actually get your basis out first, and that's your basis. That's no taxes at all. And then do something called wash loans to basically access parts of your other cash value and not really have an interest that you're paying on it. Now, that will impact your death benefit and certain other nuances. And there are various restrictions on holdings in PPLI. There's different interpretations. There's things you need to know like DAC, deferred acquisition cost, and cost of insurance. I'm not saying it's easy, but it is something for those with more significant wealth and are active in alternatives and things that are taxed a lot. Let's use that word, and probably getting a lot worse under the Biden tax plan. You have to be familiar with private placement life insurance, and I would even argue private placement variable annuities. And this
Absolutely
interplays with cryptocurrencies for those of you that are significant wealth holders of such an asset. What's the nuances, Dan? Like historically, we would talk about for more extreme asset protection, you may have some domestic trust in states that are going to be favorable. But if you want to get more hardcore, you would look at a Nevis or one of those offshore locations where the trust is structured, but you may have the assets even out of the US, like in Switzerland. How does this interplay with crypto assets, the uniqueness of it's a bearer asset, and who controls the keys controls the, let's go with Bitcoin?
Yeah, well, I mean, so always, no matter what, if you contribute assets to a trust that's irrevocable from an asset protection standpoint, you may you will likely suffer some form of a tax consequence on that contribution. So be aware of that if you make it a perfected gift, right? So we got to watch that, right? So my view, and every international advisor has their own favorites. I like Nevis and the Cook Islands. Other people like Belize. Other people like Panamanian foundations. I like Nevis because the person who led the writing of the legislation's a friend of mine. So I have a little bit of bias there and its interpretations. I like the Cook Islands because it's a protectorate of New Zealand. It's old school. It's it's closer to the dateline. I don't have a language barrier in Nevis either, but I like good jurisdictions. So if you have a portfolio of crypto and you contribute to an asset, you may have a tax consequence on the way in, depending on how it's gifted. But then it becomes party to the trust. The trust can then reinvest it. It can sell it. It can be subject to, and it may have, again, sometimes these are treated as grantor trust for U.S. tax purposes. Sometimes they're treated as independent trust, depending on who the beneficiaries are and how they're designed. Clearly Switzerland's the best banking system in the world. It's old. Your money, I call that my row my boat money. When I have a family put $50 million into a Swiss bank account that's really in a portfolio of hard assets, gold and portfolio and liquidity, that's to restart the world money. But in the world of crypto, it's all a function of what my basis is and the fair market value. Clearly, the earlier you start these processes, the better. If you have an asset that you think is going to skyrocket, get it in early. Let it grow outside of that estate tax growth. You still may have an income tax standpoint, depending on how it was designed. There are some states that have got decent asset protection. South Dakota, Alaska, Nevada tend to be common, but that's underneath U.S. jurisdiction, so not quite as strong.
Right. And, there's lots of debate. Some people that think that Bitcoin and Ethereum are relatively mature, the massive multiples are gone. But trust me, there's people I talk to that feel there still is much more room to run, especially a couple of years out in something like Ethereum. Look at how well it's doing now. I know someone that believes it could still go up even hundreds of times what it is now. So you'll have to make your own decisions on that. But the opportunities for the kind of trust that we're talking about, depending on what your goals are really, really important to know. I completely agree on Nevis and the Cook Islands. It gets a little complicated with crypto from some of these perspectives, not just the basis may be low and you got a tax implication going in, but what I mentioned earlier, from trust provisions to bearer asset to who controls the keys. Here in the US, a lot of families of wealth are owning it where they're using professional level custodians, a NYDIG, a Fidelity. I think the JP Morgans and Goldmans are going to start to enter this year. Internationally, there's already banks that are doing it. So again, talking with someone like Dan, a family may want to get really hardcore here. Like I said, Cook Islands and Nevis for the trust, but the actual keys. Now, a maximalist would have a heart attack. I get it. Not your keys, not your Bitcoin. I hear you, brothers. I hear you. But again, most people are not like that. They would perhaps even rather have a professional custodian. They're afraid of handling their wallet or cold storage or whatever they're doing. So there is no easy answers here. For many of you whose wealth has been created, perhaps even to millions or tens of millions through Bitcoin and crypto, this is like a whole new world that we're bringing up. CRTs, CLTs, banks, captive insurers, PPLI. We're coming at you with a fire hose in relatively a short 1 hour program. But again, do the research, form your own thesis, and make your own decisions. Dan, is there any implications where MicroStrategy kind of started it with Michael Saylor, but we're starting to see companies now replace cash on their corporate accounts with Bitcoin or Ethereum? And obviously it's been, I guess, the better investment play, obviously, for the last couple of months. do these, or I guess when endowments, foundations, or institutions own Bitcoin, then they don't have to worry about the tax picture.
That's interesting, because so let's start with the nonprofit world, the endowments and the foundations. Don't forget there are 5 things that tax exempt entities can earn without paying tax, and that's rents, royalties, capital gains, dividends, and interest. So being property is quite helpful. Now, I think it was last week that Tesla indicated that they made $101 million or something on a Bitcoin swap. But that was a strategic decision. It worked out well for them, right? Whether they can repeat that, I don't know, right? So from a corporation standpoint, whether that meets your treasury functions, it certainly meets the liquidity standards, right? It can. I don't know if you could liquidate $100 million worth of Bitcoin quickly, but fairly quickly, right? And so it can be, the nice thing about Bitcoin, it's fungible. Look, anything that's recipe driven, who suffers if in a Bitcoin market? I teach a course in this for CPAs, and I remind people that, in essence, I can now transfer wealth across the world for pennies, literally pennies. And whereas if I want to go to JP Morgan or Bank of America and transfer that same amount of money, I've got all this KYC, I've got all this due diligence, I've got delays, I've got exchange rates, I've got fees. So I just shortened all of that. So all that commerce standpoint will move ultimately to the blockchain. It'll take another generation, right? To make it easy. Of course, that's one of the places where the government may be slowing crypto down. Banks and banking associated with crypto assets and exchanges is a challenge, right? They don't feel comfortable about it. The risk management teams, they're worried about the currency, they're worried about the sourcing. So there's the temperament. The damper may not come from the government directly. It just may come from the FinCEN and U.S. Treasury on the indirect know your customer information. So there are ways for the government to kind of control it.
And for U.S. citizens, I didn't bring up from an income tax perspective. And I know a lot of my audience, especially if you're watching this on YouTube, kind of the family office stuff is newer to you, and the advanced asset protection and estate planning. But it's good that you get this coming at you hardcore. And you could go back through parts of my channel or other resources and get some more detailed about some of the nuances. We had the attorney Martin Michaels on buying banks in Switzerland back from Baker McKinsey in Switzerland back in October. So we have some of the resources there. But one strategy that we brought up before and still has not really taken off, a little bit like private placement life insurance, is a U.S. citizen moving to Puerto Rico. Unless that rug was pulled that I didn't know about, that could be a tremendous tax advantage for those that may be active in the crypto community. Talk a little bit about that.
Puerto Rico is a wonderful epicenter for our active crypto communities, along with others. Clearly Puerto Rico has its own structural challenges, and they've got a tax incentive to help bring businesses and or wealth down there. Some under their various acts, maybe a 4% effective all-in tax rate. Some people could get to 0. Land prices are doubling in Puerto Rico in the preferred neighborhoods. It's probably perceptively wonderful from if you're a single or a nuclear family without school-age children. Some of the people who my groups of customers that have gone down there with school-age kids haven't found it as wonderful, right? Structurally, just has some challenges, but absolutely, done correctly, you can take assets, you can invest down there, you can be in a 4% or a 0% gain tax rate. You can effectively leave after a number of years, right, and repatriate back to the United States, for example, without a subsequent layer of tax. Whether that loophole I don't believe in the word loophole, whether that avenue will be closed, untold at the moment, right? I think that the biggest challenge, like all of these, people want the benefits of Puerto Rico. They just don't want to suffer suffer is the wrong word. I don't mean it that way. They don't want to make the investment necessary to do it correctly, right? They want to spend too much time. It's like people who want to live in Monaco but really live in Nice, right? They reside in Monaco, but then they're just running it a little bit too tight, right? They want to live in Cannes, right? Nobody wants to live in Monaco. So you've got to understand what you're getting into. I represent an American family. They've got a large amount of crypto, very large, and of course it's all gain. They've got kids. He said Puerto Rico's not on the table. So what else do we have, right? We have to do something else, right? And it's not against Puerto Rico. He just wasn't in a spot he could go to Puerto Rico. So,
right. The one thing I will say about that, did you hear what Dan said earlier? And I did a session 2 years ago with Alberto Bacco. Go back and watch that one. We'll do more in Puerto Rico and the U.S. Virgin Islands as well. But did you hear him say 0 to 4%, like 0% on long-term capital gains and 4% on income? There's nuances. I'm simplifying it way too much, but there's nothing for a stateside U.S. citizen that's going to give that level of tax benefit. I mean, that is like that's the top of the food chain. So it may be, again, if we're throwing a lot of new concepts at you, something to consider. I'm going to change directions a little bit. If the audience has further questions on crypto, please send them via the chat feature. I'm going to mispronounce it. I always do. But have you followed the Bill Wong of Archegos story? The former hedge fund turned single family office and massive swaps and how that all kind of tanked. Is that something you're familiar with, Dan?
I'm not familiar.
Okay, I'll give
Sorry.
I did something 2 weeks ago with the attorney Tom Handler that is already up on my YouTube channel, so check it out. Bill Wong started from nothing, worked for Julian Robertson, built up a net worth of 200 million, amazing, and converted to a family office, his own family office, a legit family office, approximately 2013. And being a great trader and not having the constraints of LPs and institutional LPs that dampened his volatility, like a lot of the managers that convert to an SFO, they could do whatever they want. And a lot of them are really, really talented traders. And I know so many that are dabbling. I keep my mouth a little bit shut, but in crypto, and not even just Bitcoin and Ethereum, well beyond that, because that's where the asymmetrical opportunities are. But Wong, as far as we know, didn't do any of that. The man in 7 years, through significant swaps at major institutions, so he kept under the radar, but not illegal, as far as we know so far, turned his own 200 million into, at peak, what might have been as much as 30 billion or more. That's 150x return on a massive amount of capital. That's more net worth than Ray Dalio and Steve Cohen, and he did it in a limited window, incredibly concentrated, and was like effectively exclusively swaps. The banks knew what they were doing. Oh, they were profiting to $100 million a year. They loved Bill Wong until it didn't work anymore. And then some of them, Credit Suisse, and I forgot the other, I think it might have been Nomura, got hit hard.
Right.
I don't know if you want to jump into the tax implication because very few family offices are going to be aggressive in the swaps market. But if you wanted to comment or say a word or two, I'd love to listen.
Well, it's
a tough one. I'm sorry, Dan.
Yeah, look, you get into those kinds of avenues, right? And you've got whether what kind of income, where's the income, the growth, the losses, the risks, hyper complex, right? And you've got, don't forget, taxes are always going to come down to income, right? Whether they're a capital gain based on appreciated income or they're ordinary income and losses. And then you've got whether or not the income was or was not appropriately done. I don't know the details, so I probably just ought to not I'm not gonna take the fifth here, but I'm gonna avoid the answer, I guess.
No, those are fair. And I was going to bring up asset protection issues for someone like him that on paper was
Yeah.
30 billion and now could be wiped out, but we don't really know. We don't have the full picture. Did he have offshore trust? Did he have a start over fund? Is this the kind of guy that could get 150x return again, starting with lowly a couple of $1 million? I find investors
I think it was Dale Carnegie. I may be wrong, but I think it was Carnegie that basically said, take away my factories, right? But give me my human capital.
Yeah.
And in 2 years, I'll be back. So, people who are that successful aren't going to stay down. There will be believers, and doing it again's tough, but going from 200 million to 30 billion, and I don't care how you did it. I don't care how many screw ups they had.
It's pretty much unheard of.
Yeah, they got it more right than others. Now, will it be in the same asset classes that he did before? Probably not. But don't forget, there were other sides to those swaps that thought they were taking great advantage. I mean,
Yes.
Michael Lewis was on 60 Minutes last night.
Oh, I missed it.
And and it was and he writes well, and he does great work. Right. And if you think about The Big Short, think about all those people in The Big Short that were just taking advantage of the crazy guys that are out there who can see the world differently, and they were willing to profit from it until it bankrupted them. Right, the guys who took the gamble won. Right, so I would tell you that Mr. Wong, he may be down on the mat a little bit, but he's not knocked out, and I don't know him.
And a part of that's going to depend on if he had personal guarantees that we don't know, what offshore assets, could he sell his $10 million home? That guy would turn 10 million into a lot more money. And don't think that he's not dabbling on the side in the doges and all this cryptocurrencies. He's a brilliant mind. And I would love to know more of what he's doing, but being a private entity as an individual or family office, in my opinion, it's none of our business.
That's right.
Don't get me, onto my libertarian views and all that sort of stuff. That I could go on and on this subject. Let me ask you another question that a member did ask me about. Angelo, how come Bill Gates is buying so much farmland? What does he know that we don't know? Perhaps as an agriculture play, but I'm not going to ask you that investment question. But are there some tax advantages to farmland, livestock? I'm assuming yes, but is it what it used to be decades ago?
Well, I think, and again, I'm not privy to Gates themselves, but look, ag tech is clearly prime for an explosive capabilities. Not only do you have automated farming, but you've got new AI aspects. We've got technologies that modify how we fertilize or soil enhance to the kind of soil I have on this acre versus my next acre, right? So those yields and those harvests. The other thing is we've got multiple billions of people on the planet that are unfortunately going hungry on a daily basis. That would be in alignment with the Gates' spiritual. I mean, their philosophical, their vision statement, right? Let's find methodologies to help them. Land is always at a premium, and as we try to figure out how to harvest more, it's also a hedge for inflation, right? What do you do with a stock market that every day people are saying, gee, I just don't know how much further it's going to go up, and then other people are going, oh, it's going to double again, right? I mean, somebody's going to be right. Stock markets are going to go up or go down. One of those is correct. We just don't know which one. So, I suspect it's an alignment in that kind of a vision as a methodology to say, how are we going to take ag tech and take these interesting crypto capabilities or distributed technology capabilities, add that to engineering, satellites, automation, and harvest more in a safer environment without destroying our planet. So I suspect it's in that alignment. But then are there investments in there? Sure, R&D, research. You've got other aspects as it relates to growing things. The president talked about, let's have people grow things that help carbon sequestration and get paid for it. So sometimes, planting things that are not only beautiful but helping the environment may be something as well. Let's try things. So I think the Gates and the people like Gates are looking for methodologies to enhance the world and profit from it. That's all good stuff.
Of course. And there are some tax advantages. We actually, now that I think about it, Jay Garado, I had on November of 2020, we did about an hour on farmland. My God, in the last 5 months, I actually covered, because I do these so often, so many damn subjects. As I'm talking to you, I'm starting to think about all of them that are kind of popping in my head. I would actually like to redo that one. And maybe we'll have a special guest on that sometime later this spring or summer. But I'm also intrigued by farmland. Maybe my last subject, and again, the audience, if you have any questions, feel free to shoot them over via the chat feature. Kind of a word that I use a lot, and I hinted at it earlier. There are people that are going to make a decision, whether from a tax perspective or whether from simply it's what they want from their lifestyle, to consider as a US citizen, what could be some of my options, especially per their perspective if things go to hell in a handbasket. So they look for jurisdictional fluidity. They start by doing research. They look on different continents. They usually start to narrow down, and then they look into, do I, of course, go visit and get comfortable, but residency and property ownership and citizenship, dual citizenship, possibly given up after they're comfortable, their US citizenship. And there's some of the usual suspects in the Caribbean, Panama, in Europe, what used to be Cyprus, Malta, Montenegro. I'm hearing very positive things about Poland. And some of these are not perfect from a tax perspective, although some of them are. And again, other countries often don't have the onerous system that we have with the IRS following you all around the world as a citizen. There's much more flexibility in citizens of most other countries with where income's earned. And again, we could go on and on about it. But what are some things that you may see people, crypto holders and others, explore about their jurisdictional fluidity?
Absolutely. Leaving the United States, if you're a U.S. person, has a tax consequence above $600,000. And you also have issues if you're a child, but your parents decide to grant you a trust or something later. You've got some recapture taxes. But let's assume that we look at Portugal, their golden passport, or Italy has some caveats as it relates to if you'll come drive business, right? These are all mechanisms to help stimulate the economy. Well, one of the things I would advise people, though, is think about not just from an income tax standpoint, but from an estate standpoint. Don't forget, we live in a common law jurisdiction. England, English common law. A lot of Europe is civil law. Inheritance rights are forced in a civil law jurisdiction. Your domicile, the home that's your home when you're no longer at home, is paramount. So if you become a Portuguese citizen and then after a few years you decide that you want to live somewhere else, and then you change your domicile, Portugal might say that's fine. But if you decide to leave that place, let's assume you decide to live in Geneva for a while, and then you've said, I'm now Swiss from a domicile standpoint, but then you leave in your older life to go to the Caribbean where it's warm. Well, Portugal will say, well, you never really left Portugal then because it's, and they'll reach out at the estate and inheritance standpoint, and inheritance rights. So people can save money in their lifetime, but they may have just shafted their future generations. Things to think about. And one of the areas that I do some work in are what we call, from an estate standpoint, of mixed marriage, right? You've got people who are resident of whether they're Sharia law or civil law or common law, and we've got mixed domiciliation and mixed origin that create an estate tax problem that people aren't thinking about on a regular basis. And all of that asset protection is about a global perspective on how to see that the family has the best footing for the next generation and the future generations. And you cannot look at it in isolation as this year's income tax or next year's or this bucket, right? To look at it with my crypto assets without thinking about my real estate portfolio, about my stock portfolio, about my private equity portfolio is mistaken in my view, right? Crypto is just an aspect that's sexy and fun today, and it's got great value. And I think it'll be driving our economy for the next 50 to 100 years as we move from an old technology of wealth and money to a new one, right? And there will be changes, and there will be a lot of bloodletting as well, right? I mean, you and I at one point chatted about, I reminded people that in the 1920s, there were 2,000 auto manufacturers in the United States. And by the 1950s, probably 5, by the 1960s, 4, by the 1970s, 3, and I would say 2.5 are really US incubated auto manufacturers, right? That doesn't mean that cars aren't being made. It just, but if, and same thing, computers did the same thing and software did the same thing. So it's reasonable that crypto assets will do the same thing. There will be a thinning of these opportunities, and people should be balancing their portfolios and thinking about that.
Yeah, I mean, what I will say from some of my experience being very active in the crypto and digital world, especially if they're Generation Z or younger millennials, they are like, there's nothing else but that.
Right.
You bring up, 10 optimistic 10 or 20% returns to the stock market. It's a joke to them. And I used to laugh at that too and still feel it's weird and I don't quite get it. But when you look, and I know many of them, Angelo, I'm an on-paper millionaire and I never expected it. Oh, and I know some that are deca and hundreds of millions on paper. Yeah. They won. Now, we would argue, that's amazing. Could you please take some chips off the table?
Right.
Maybe diversify a little bit into currencies, into real estate, into, my God, might I even say muni bonds? I know that sounds boring, but if something were to happen, could you at least know that 10 or 20% of your resources, I know they're not going to have complete diversification. I'm still saying that they're going to have 70 to 80% in the more aggressive strategies, but I just don't know about 100%. Yet, on the other hand, for the last 8 or 9 months, they've been right. But again, what goes up goes down. What goes down goes up. It's tricky.
I think it was Taleb in I can't remember if it was in Fooled by Randomness or The Black Swan, but I'm sure it was Taleb who said that we rely on yesterday too often in our predictability in the future. And he tells the story about a turkey that's raised for a couple of years. This farmer comes out every day. This person feeds the turkey, and the turkey's having a good life. And then one day the farmer comes out, instead of a food, it has an axe, and it's Thanksgiving. And so nothing in the previous 2 years history of the turkey predicted that the head was going to lop off, right? So while the last 9 months have been on a rocket ship up, we all understand the temperaments of markets, right? You've got, we mentioned it briefly, the president and certain members of Congress want to change the taxes, doubling capital gains tax. I don't think that'll happen, but doubling them, raising corporate tax rates, changing the rules, reducing estate taxes, making it more difficult for people to navigate and control their taxes under the theory of fairness and justice, and all of the reasons that people who benefit from having other people's money. So, and by the way, that's a global pressure that has been around for 20 plus years on an increasing crescendo, and is led in part by the OECD countries. So if you want to be in the saying, okay, if I'm a wealthy family, how do I put my assets in things that can grow without that annual redistribution? I was going to say theft, but that's probably that would be maybe prospectively wrong. So it's not theft, it's taxation. But that redistribution, right? So does that mean that the president's going to be successful? No, the president isn't going to be, right? The most popular senator is our senator from West Virginia, right? I mean, no tax act can be any more aggressive than what he currently stands for on a party line basis, right? So, and I think that's Senator Manchin. Is that correct? I may have that right.
No Manchin.
Yeah. So there changes afoot. California is going to push. I mean, Gavin Newsom, assuming he survives his recall, is going to push taxation forward, right? Maybe 14, 15%. You can, under the Biden plan, California's marginal tax rate, I think, is 59%. That will be a disincentive for a lot of people, at least emotionally, to earn money in California, and it'll be an incentive for people to vacate California and go to more friendly,
Texas,
friendly jurisdiction. Well, yeah, there's a reason that Florida is sinking. I think all the people from the north, is running down to Florida. But yes, Texas,
in the
Tennessee,
Northeast, yes, out
Alaska,
west.
New Hampshire,
True.
Florida.
I mean, there's some pockets, Wyoming, Nevada, etc. But definitely the two big winners in that have been Florida and have been
Absolutely.
Texas. We could even do just a whole show dedicated to that. I've been to Florida like 6-7 times in the last 2 or 3 months, specifically South Florida. It is exploding office real estate going up. It's the only place in the world during COVID I could think where that's the case.
That's true, and their infrastructure is suffering from the massive.
It makes LA traffic look good.
Yes, absolutely, and so and there's a balancing, right? There's an equilibrium that'll be found, and it's always a challenge, right? So families need to be nimble. They need to stay afoot of it. And some families will say it's just the consequence of being here, and others will say, but 100 years from now, what decision should we be making, and what's my time horizon, right? So pay attention to it, think about it, always check it in. Nobody ever lost greatly paying taxes, but a lot of people have lost greatly not paying taxes, right? The tax cost is something that can be navigated through, and sometimes it's a tough bullet to bite. But if you're in a high tax jurisdiction like New York or California, there are ways even domestically to defer the state tax consequence and do it legally. And that's really an opportunity as well.
Well, Dan, we covered a lot, yet I feel there's so much more we could do, like deeper dives into, which we will over the next couple of months with Dan Morris and others. So very excited about that. Dan, for those that would like to learn more about you and your firm and how to connect, how could they do so?
Well, the easy way is to look up cpadudes.com. That's cpadudes.com. But if you don't think that that's very politically correct, we are at morrisdeangelo.com, right? I mean, we're a California formed firm. We have offices along the West Coast. We have key personnel around the country, and we've got affiliated footprints in every tax haven in the world. So we've got a great global presence. But those are the two best ways. Email Dan at cpadudes.com, Twitter at MorrisCPA. So we're around. We're happy to help.
That's fantastic, Dan. It's always a pleasure. Everyone, I am Angelo Robles, host of the Angelo Robles Podcast and the founder and CEO at Family Office Association. If you're not a member, go and check us out. Very simply, familyofficeassociation.com. Members have many benefits, first and sometimes exclusive access. My master classes, which I'm revamping my foundational one on creating and adapting to an antifragile family office. And I have a project I've shared some on Instagram, and I'm Family Office Association on Instagram, where kind of unique creative questions for families of wealth and really anyone, their children or anyone, to ponder. And they're a little different, but so am I. So what do you expect? So I do recommend Instagram, familyofficeassociation.com, and on YouTube, where probably about half of our interviews, although sometimes it takes weeks and weeks and weeks, make it up on there. That would simply be Family Office channel. You'll find it. I'm taking up too much time. Dan, thank you so much. Everyone, thank you for our live audience, and looking forward to a busy week. Thank you. Bye, Dan.
Thank you. Bye-bye.